morning, everybody, and welcome to Squawk Box, first in business worldwide. I'm Becky Quick, along with Joe Kernan and Carl Quintanilla. A recession is an absolute certainty. At least that's according to our next guest. He thinks investors should actually be looking outside the U.S. to invest. Right now, we're joined by Peter Schiff. He's the president of Euro Pacific Capital. He's also the author of the top-selling investment book on Amazon.com, Crash Proof: How to Profit from the Coming Economic Collapse. Peter, thanks for joining us this morning. I got to ask you right now, bearish right now, what worries you the most about the markets? Well,
it would take an hour to go over the list of what worries me the most. But, they say there's an old Wall Street expression that no one rings a bell at the top. Right. And, my experience is they do ring bells. Very few people hear them. That's the problem. I think what's happening in the subprime mortgage markets is one of the loudest bells I've ever heard.
With the subprime in particular. Okay, so that's your biggest concern? You think it's going to spread beyond the subprime?
Well, of course. It's the subprime is just the tip of the iceberg. You've got the Alt-A mortgages, which are pretty much the same thing, only the borrowers have a little bit better credit quality. But the problem is people lied about their incomes. They stated phony incomes and phony assets to buy houses they couldn't afford. They financed them with teaser rates. And as those teaser rates are resetting, there's no way that these people can make these mortgage payments. They were betting on appreciation. The appreciation isn't there. This is a huge mess, and it's eventually going to permeate through the entire mortgage market. Even the prime loans are going to go bad.
Peter, there are a lot of people who think we have not seen the worst of the housing market yet, but there are also a lot of people who say that's okay. It may get worse from here, but it's not going to rock and roll the entire market, that we will get through this.
Well, they can. They don't understand the extent to which the entire economy, all of our phony economic growth and our phony corporate earnings have been dependent on Americans borrowing money using the inflated values of their homes as collateral and spending it on imported consumer goods. Without that home equity, you can't have this prosperity.
I remember when you were first on, Peter, I remember Prechter wrote, he had a couple of similar sounding titles that from a few years, I don't know, 6, 7 years ago, remember? Crash, 97, something. Let's say, will you come back in 18, when will we know if this doesn't happen? And will you come back at that time, if it doesn't happen, and say, I was absolutely wrong? Or will you go on for the next 30 years constantly talking like this and never really say, okay, it didn't happen?
Joe, we don't have 30 years. I'm sure I'll be on many, many times between now and the time that everybody finally acknowledges that what I wrote in that book and what I've been saying for the past few years is correct. It didn't take 30 years for the dot-com bubble to blow up. I started talking about that and writing about it in 97 and 98, and people were saying the same thing, and it only took a couple of years.
Okay, so then when will we know for sure whether subprime causes a true calamity? How
well,
long?
I think we will either be in a recession, and I've been saying this now for a year. It's either going to start sometime this year or early 08. So we don't have to wait very long.
Okay,
so how's it going to, walk us through sort of the data points here. We see a spike in foreclosures and then spending falls off a cliff. What happens? What's the ABCD?
Well, what's basically going to happen is you're going to start to see the people who have been supplying the credit to American consumers, mainly foreigners, but also hedge funds who have used various strategies, but a lot of foreign central banks, they're not going to want to lend money to Americans anymore, and interest rates are going to rise. When interest rates rise, people stop spending. At first, people will struggle to make their mortgage payments, which means they're going to stop spending money on everything else. You're going to start to see that ripple through the economy. We're going to move into recession. As the U.S. economy moves into recession, the pressure on foreigners to dump their dollars is going to intensify. As the dollar really comes under free fall, then you're going to start to see consumer prices in this country for food and energy and clothing and things like that start to go through the roof. That's going to really pinch the economy. You're going to see higher inflation, rising interest rates, and it's going to set up a spiral. And we're not going to just go through a shallow recession like we had in 2002. This recession is going to go on for years, and it's going to be very substantial.
Peter, if that's the case, and you think that's what's happening, my guess would be if there's a recession here in the United States, that's something that affects the rest of the globe. Where would you be putting your money?
Well, it's going to affect the rest of the globe, but ultimately it's going to do so in a positive way. See, the problem is the world has been supporting 300 million unproductive Americans. We are using up all their products that they consume and borrowing up all their savings. So when they stop supporting us, the rest of the world enjoys greater consumption, and they have a lot more money to invest and borrow in their own economies. So what I've been advising my clients to do, and it's worked very successfully for the last 7 or 8 years, is to avoid the U.S. market totally, to avoid U.S. currency, U.S. bonds, U.S. stocks, and instead invest in alternatives around the world, in Europe, in Asia, conservative dividend-paying stocks, corporate and government bonds. We also have been buying a lot of commodities, natural resources, precious metals. All these strategies have worked very well, and I think they will continue to work well in the years ahead.
Okay, Peter, I'm not sure if you've heard about it, but we do have a $1 million portfolio challenge going on right now. If you had $1 million, what would you do with it right now? What would you be telling someone to do with it?
Well, again, the same advice. I have 3 chapters in my book that tell you how to invest the money. But again, I would put the bulk of it into conservative, dividend-paying foreign stocks,
right.
Utilities, commercial property, resource companies, and I would probably put 20 to 30% of it in natural resources, commodities, precious metals, in a combination of stocks and physical metals. If you want to be more aggressive, I mean, personally, I've had better than 50% of my own portfolio in gold stocks for years.
Peter, you thought we'd be in a recession by now, though. Previous times you've been on there, back in 05, back in 06. I mean,
I've been calling 07. If you play back some of the tapes that
Okay,
prior
so 07. All right.
But I've been pretty accurate. If you look at what I wrote a couple of years ago about the housing market, I mean, I pretty much laid it out exactly the way it's unfolding. Well, very few people predicted it.
It's just scary to listen to that was a horrific scenario you just painted for us over the next couple of years. As the planet's going to be warming, and the
Democrats
glaciers
winning
are going
the White House.
Democrats going to win, and there's going to be flooding hitting there's the glacier. It's a bad.
Well, I don't know about global warming, but most of the bear scenarios out there are too bullish because they don't understand that we're going to have inflation and a falling bond market at the same time that we have recession. People think that they can take refuge in the bond market. People are going to get killed in bonds worse than stocks.
All right.
Okay, Peter, thank you, I think. Rough stuff to wake up to on a Monday morning, but Peter, always good to talk to you.
Thanks for having me.